with COVID, hopefully it's opened up a lot of things last year. People are saying, maybe we should put more towards our, what happens if, and not just what happens when we retire, but what happens if something happens to us, and so on. So people are worried about legacy planning the most. A lot of people are worried about how their heirs will handle inheritance. So imagine a case, last year we've had people who passed away, and all of a sudden, maybe they didn't have a will or an estate plan set up, and all of a sudden their children who aren't ready for the injection of money are now receiving it. Or maybe the fact is, the younger generation aren't even ready, psychologically to inherit money. I was reading a good story today, I think it was on Twitter. In Ontario, they're going to be teaching grade 9 children how to save for a down payment on a mortgage, as well as save for retirement. These are things that have never been taught at any high school. University does not teach these things either, because they teach more, larger, highbrow topics. So financial literacy is still a huge thing, where just this discussion at the kitchen table, what happens if, when, then, and now. And the last thing, maybe a chunk of people don't trust their children's spouse to manage their heirs' inheritance money. So the other thing is, what happens, if someone's not there the next day? How do we plan for things? So this it's from AIM Trimark. AIM Trimark doesn't really exist as a company. It's called Invesco. I've had this since 2001. And a simple question when it comes time to looking at a wealth transfer, retirement plan, estate transfer, what's important to you? So for everybody who's got different perspective in life, what's important to you? I'll take a brief pause there. I'm going to take a look at it though, but maybe it's an estate plan, having a wills in place, trusts in place, the insurance, who will be my heirs, who will be charities. Retirement, the biggest risk people have retirement is, what if I outlive my money? How am I going to have funds for the future if I've actually at a point where I have nothing left in the bank or my investment accounts? For a lot of people, they overlook income protection. How am I going to guarantee my paycheck? What if I had a major illness? What if I passed away presumptively, or even as well, having just my prescription filled? I think the idea of a sandwich generation as well, where it's one thing for a family to say, well, I have to assist my children with their college, university, and maybe they might not get a job right away, but also the sandwich generation, where we look at, okay, well, our parents are elderly and they're in a care home and they need to have care around the clock. So very important is, when it comes to any financial plan, it's very simple. You get away from the investment returns and what this is going to do for you. It's very simple. What do I want to achieve? That's the big thing. Once you have that, and that's kind of the mindset, it's where you want to go. If we're going to be drafting a hockey team like in Seattle last week, so we have 30 teams, because the Vegas was exempt from taking a player. How are they going to draft that team for the potential on the ice in like September, October, as well as the free agents, and then other trades? So very important to you. How are you going to address what's important to you? As we then take a look at what's important to you, a lot of times as a financial planner, we do a lot of our written financial plans. So our work we do is not just about, how do we maximize returns given a risk and putting some insurance in place. It's actually looking at, well, let's plan to age 90. So as you're growing your assets, at a certain point, you're going to access your money. There's also a chunk of money perhaps you may not even touch, and that'll be transferred to the next generation. So a lot of estate planning comes down to is, well, why pay tax on the money I'm just going to transfer? Let's create a larger estate, or let's find a way to minimize taxes. So very important in that work, where as we get to the final result of our estate plan or to our wealth transfer ideas, let's take a look at where we are. And your total net worth, it can be broken down to many things. So traditionally, your fixed income investments, could be something as a GIC or term deposit, maybe a bond portfolio. How about your equity investments? Perhaps you own a business, own real estate, maybe you own even a cottage, and that's a secondary property as well. And how life insurance as well benefit. So each of these 4 different areas, they have different growth and risks, how they're taxed, how you can access them, how you distribute to them. One of my good friends in the business, and I've been mentoring him for many years, but he's also mentored me. And he goes, John, how you label your money is how the government's going to tax you. I'll say it one more time. How you label your money is how the government taxes it. It's very important. If all your money is in an RRSP, that's fully taxable when you take it out. If all your money is a TFSA, tax-free savings account, that's going to be obviously a tax withdrawal, but certain limits though. If some clients say, well, all my money is my real estate and I have 5 houses, there's a tax man who wants to come talk to you in the future. Plus, if you want to access cash through real estate, aside from rental income, you'd have to borrow against your assets though. So again, as we take a look at our big picture, see where is our money. So let's take a look at the assets in our wealth generation transfer. So the first one will be the RRSP, Registered Retirement Savings Plan. This is probably the most popular plan in Canada because it was made, I think, in the 50s or 60s as for people who didn't have a pension through work. So very simple, an RRSP, it's tax deductible contribution, it's tax deductible against your income. It's tax deferred growth. A lot of times people say it's tax free. I don't like that word because ultimately when I pull the money out, I have to pay tax on it though. So I would rather label RRSP as tax deferred growth because I will pay tax in the future. It's taxable withdrawal. So if I take my money out of my RRSP in the form of a RIF later on, or if I just take random cash out of my RRSP, I pay tax on it. It's taxable at death. So that means is if I passed away, and let's say I was by myself, the whole value of my RIF, which would the RRSPs become in the future, will be taxable to me. If you're married though, and your spouse beneficiary, that rolls over to your spouse. And when that person passes away in the future, it becomes taxable at the end. So there's always, with being married, as a spousal rollover works in many different areas. The tax-free savings account came out in 2009, the TFSA, very popular. Different than the RRSP because it's after-tax dollars contributed. So you must, let's say, earn $7,000 to net yourself $5,000 to invest in tax-free savings, but in RRSP, you'd make $5,000 gross and put away $5,000. So that's the one key thing with the tax-free savings. It's after-tax dollars. Difference though is it's tax-free growth because it is tax-free, a tax-free withdrawal, and the death of a tax-free savings account holder is a bit different. If your spouse is a successor holder, then your spouse basically inherits this TFSA as is. So if you have both maxed out your tax-free savings account, one passes away, the surviving spouse will then basically hold 2 tax-free savings accounts, or you can transfer them eventually into each other, but basically one giant tax-free savings account. Or you can choose a beneficiary designation where, let's say this be someone other than a spouse, where someone you passed away and you left your tax-free savings account to your son or daughter, then they just inherit the value of that account tax-free. So very important is for the people that are married or common law, make sure when you look at your tax-free savings account, do ensure that if it's part of your estate plan that the other person inherits, better to have be successor holder and not just beneficiary. Most companies will offer this anyways. So with the tax-free savings account being very popular, we have less focus on the non-registered investments or savings investments. So before tax-free savings came about, we would put in the RRSPs first typically, and then the surplus goes into non-registered savings. So non-registered means it's not an RRSP and you'll get tax ups every year. So again, after tax dollars contributed, and very important, tax is dependent on the types of instruments you're invested in. So for instance, interest income, it's the highest taxable investment. It's based on your own tax bracket. So if I compared interest, capital gains, dividends, or even interest as well as like employment income, interest and employment income are actually taxed the highest rate possible based on your own tax bracket. So a lot of times you're going to invest in a GIC, maybe a high yield savings account, a bond or a mortgage, which collects interest to you. And each year you receive interest, you'll also pay tax on this with a slip, usually a T5. With the interest income. So let's say, a person had a GIC and they made $5,000 interest. They passed away during the year. That income growth, that interest will still be taxable to their estate. Dividends, it's your share of a company's profit that are paid out. So let's say Royal Bank, pretty big company in Canada, they do a quarterly dividend. So based on how many shares you own in the company, they're then going to give you out a payout based on so many cents per share. And most mutual funds, the dividend funds are very popular as well. So with a dividend tax credit, you actually pay lower tax with dividends than you do in regular interest income. and dividends are taxed yearly as earned. So if you're holding a stock portfolio which is non-registered outside of your tax-free savings or RRSP, when you collect dividends, they'll issue you usually a T5 or T3, usually T3 actually, and they'll say this is your T3 because you earn dividends on your investments. So typically, interest and dividends, you will pay tax on them every year as you go on in a non-registered savings investment type vehicle. The next part is capital gains. So this is an interesting area here. An unrealized capital gain occurs when your investment rise in value, but you've not sold them. So let's say on January 1st, you had a collection of stocks or mutual funds or even bonds, and at your June 30th statement, which you should have got, I think by now, it's grown in value. Because it's only on paper it's grown, you don't pay tax on just the growth on paper. You only pay tax on a realized capital gain. So realized capital gain occurs when you actually sell the investment for more than you purchased it for. There's also capital losses, which is when you actually sell it for less than you bought it for, but obviously we're hoping you're going to increase in value for sure. It is possible though, with let's say a mutual fund or segregated fund portfolio, which is non-registered, you will get a tax slip. It says interest, capital gains, and dividends, because what happens is the fund manager, if let's say they bought ABC company stock at $20 and they sold it at $30, even though you didn't sell the mutual fund or segregated fund, because the fund manager had triggered that gain, you'll still see some capital gains on your tax slip. But for most mutual funds and seg funds, what you'll do is when you actually redeem them and sell them, that's when they'll issue your tax reporting, is to pay the tax on that. So right now, 50% of capital gains are taxable at your marginal tax rate. I put an asterisk there because ultimately there's an election coming, maybe potentially in a few months from now, and maybe that might change to 60% or 75% again. So that it's right now 50% though. So if you bought in a non-registered investment, a bond, shares in public and private companies, mutual funds, segregated funds, when you buy and then when you sell them, these will attract your capital gains or capital losses. The public companies is company you buy in a stock exchange. A private company, let's say you own your own private company. Let's say you own a plumbing business and it's you and your spouse. That's a bit different though. As long as it's called a Canadian controlled private corporation where it's got certain criteria, a lot of those capital gains on your own company, shares like that, a private company, would actually have a tax-free provision because of the capital gain exemption. Again, that's something I didn't really put in today because I want to keep it very simple today though. But that's, again, a lot of times you might have built up a business for, let's say, like the plumbing store, $100 for your shares. You grew it with your wife to $1 million. Potentially you can sell your company and actually pay all tax-free because you have a capital gains exemption for it. I think it's about $850 per person right now, actually. So if I sell my investments while living, and we'll concentrate on the capital gains at this point. So 50% of your capital gain is taxable. That's called the capital gain exclusion rate. So let's say you purchased a mutual fund growth portfolio for $100,000 and increase in value to $200,000 over 10 years. So let's ignore the interest and the dividends at this point, just pure growth. So the capital gain when you sell this portfolio is the fair market value, which is $200,000, minus the adjusted cost base of 100, times the 50% capital gain rate, times your marginal tax rate. So your marginal tax rate is the tax rate you pay for every next dollar of income you earn is how it's taxed. The top level in BC is like 53.5%. So this example here, I'd have my $200,000 minus 100 times by 50%. So you pay tax on half the gain at 53.5. I then have to pay a tax of about $26,750 on the gain of my portfolio over the last 10 years, which when I sell it. And again, assuming the top bracket in BC is 53.5. So your after-tax value is now going to be $173,250. So my 100 grand, which let's say whether I sold my house and I had money, or I inherited money, or I won the lotto, whatever it's going to be, I had just money in my bank account. Your 100 grand is your own money. That's tax-free because it's your own money. It grew and you pay tax on the profits. So at the end of the day, your after-tax value of this investment would be about $173,000. So that's while living. So very simple process. And then the proceeds will then be split. So let's say just your own or with a spouse, it goes into a joint account, individual account, and you pay tax just equally along the So let's look at sale investments at death. So let's say you have the same portfolio and you both passed away. The government assumes you have disposed of your property the moment before you pass away. This is true for everything that they tax you on at that point. So we'll use the same calculation as while living based on that capital gains, but there can be costs of selling and portfolios can be subject to provincial probate laws. The probate law is about $14 per $1,000 of estate value, which what money goes into your estate, that's how they calculate it, as well as dealing with wills and family members. So perhaps if, let's say it's so in this example, say I have a lone person, a widow, a widower, they have this investment, they have a will in place, and they leave it into the will, but their kids are arguing about it. Well, one thing is you can't argue the capital gains tax, that's the money for the government. You can't really argue the probate laws under like a mutual fund portfolio or a stock portfolio. And then you're dealing with potentially wills and family members where, you know what, well, we need a probated will. So you have to go get your will probated, which means it's stamped, it's final. Maybe family members can argue about it. Maybe there's other claims against it. So ultimately, when you're dealing with that death, it's a bit can be some troubles there. The exception to probate fees, though, is actually using segregated fund policies. These are essentially like mutual funds, but through an insurance company, and you can name beneficiary. The difference with segregated funds is they're essentially like insurance contracts. So I can say, I have the same portfolio with almost the same performance, but at death, instead of having, let's say, 6 months to a year or two for my estate to settle to pay out my family, within a few days, actually, your family does get the money. It can't be disputed, it can't be argued, and the fact you also bypass probate, though. So for a lot of people who are concerned about, leaving your investments, segregated funds through an insurance company are actually very unique to the vehicle. The exception here, of course, is we're talking about like the last. Let's say an individual person or someone who's on, a widower. But an exception, so that's what happened when they pass away. But on a joint account, if one person passes away, the other person will then take over that account. And then when that person sells the investments or they pass away, the tax pays there, though. Of course, nowadays, many different people, whether they have second or third marriages or different assets, it's very important to keep an eye on these things like, hey, I want to leave money to my kids. What's the best way of doing it, though? So again, be wary of the taxes and other fees on these things. Real estate. So your principal residence is tax-free. An asterisk again, because we're actually talking about tax intervention. Hopefully not, because there's a lot of wealth in our homes across Canada, and I think the government wants our money at one point. So whether I sell my residence and I declare my principal residence, if I sell it today or if I pass away, that's going to be a tax-free gift if I pass away. And obviously it's tax-free if I sell it. So a lot of people will downsize their home and they might move to a little cottage or a smaller area, and that process is always tax-free. Other properties, say a cottage, rental property, are subject to capital gain rules, just like your non-resident investments at sale today or at death. So if I had, let's say, 3 homes all in a row, they all had bought for the same value, and they all sold the same value while I'm living, 1 will be tax-free, 2 will be taxable, based on the same formula of the market value minus the cost, 50% of your tax bracket. And then if I passed away, the same idea would also appeal as it goes well. Difference is at death, though, I'm now dealing with my estate, a family to deal with, probate fees as well. So on $1 million estate, there's a $14,000 basically probate tax to pay to the government as well before they actually stamp your estate, though. And again, the big thing is we won't like to avoid, obviously, but family can argue, family can get disputed. There could be people who just show up at the woodwork saying, well, you owed me this money, that money, maybe as a shareholder. So again, ultimately, when it comes to dealing with a will and estate, you definitely want to have a proper will done, have an executor, and make sure these are all up to date as well. So a big thing we talk about with a lot of clients is you actually have a will in place, as well as a power of attorney. If someone had, just got married again, very important, revisit it. If someone, they lost their spouse, relook at this. Maybe someone says, well, I have a couple children, but one I'm not really close to. How do I address that? With a will, you dictate who will be guardian of minor children, which assets will flow to family members or charities of your choice. If someone dies out of will, the law in BC says how their estate will be divided. So if you don't have a will in place, the government of British Columbia has its own rules. Say, well, you didn't have the time to go make your will, we'll make the rules for you. The estate will be divided on intestacy depending on the mix of relatives the deceased person leaves behind. If the deceased leaves a spouse and no descendants, the estate goes to their spouse. But let's say that the deceased left a spouse and children. I think the rule in BC is that 50% of the assets will go to the spouse and the rest get divided by the kids. So you might have a case where, well, I have my assets, I'm enjoying my retirement, I'm enjoying my life, something happens to you, and all of a sudden maybe your kids aren't ready to inherit money, or maybe a spouse is in a care home or under care, or not the right, or another person might have other issues. Without having a proper will in place, people can inherit money. They're not ready for it though. And typically, if they're not ready to inherit the money, typically we'll find out later on, if they don't seek professional help, they may not have that money forever because they'll be pretty quick. So this actually was an article on June 15th from Investment Executive. What if you consider leaving a family member out of a will? BC's only province which has the Wills Variation Act. And this act, what it says is, if you do not treat your family equitable in your will, they can be overturned. So this example, I like it because obviously I can show my clients to it, and it basically addresses the need. You got a plan. So this is a fellow here. He passed away with $900,000 estate. He left his assets to his he left it to his two friends. Should I put it down properly? He had two adult children that left out the father's will. So these are two children where he basically fathered them, never spent a moment with them ever in his lifetime. Because they argued that's our father, and we have a loss. The government overturned the case, and all of a sudden, even though he had said in his will, if anybody disputes my will, they'll be out of it. That's an old urban myth that doesn't last in these days. That's kind of ridiculous, actually. This case, if you were to not have someone in your will and your child, they can actually go seek a lawyer and challenge your estate and go from there. What that means is you're not going to have, no one's going to have access to your estate until it's actually probated and done and will done. There's a famous case, I think it's been 10 years of one family still fighting for the money. So the whole time the executor is working overtime to manage an estate, for instance. I have knowledge with a charity I belong to that we've been named in the will of our charity in Vancouver that we're going to inherit so much money from this fellow. But one of the children says, well, this is a will was done this time. The other saying, well, this was done that way. They're arguing the will. So we're thinking we'd hopefully have a quick little settlement because we could use our church to use a little bit extra money. But this will go to trial now. We're going to have to wait for our turn though. So again, ultimately, you can plan appropriately so you don't have to deal with issues like this for sure though. So that's important there. One of the last assets to take a look at will actually be life insurance. So past few years, life insurance has been considered its own asset class because typically with whole life, universal life insurance, it's got assets, it's got investment values inside it, which you can use in your balance sheet. If you go to like Royal Bank and apply for mortgage, they actually ask you, do you have any cash surrender value life insurance? They like it because of the fact it's pretty liquid and it's conservative. Now, you may have term life insurance. This has zero cash value. And policies typically expire or cancel before insured passes. So with Canada Life, the contracts will go to age 85. And I think with Manulife, they go to age 80. So typically, and they get more expensive every 10, 20 years. So typically you might hold like a term life insurance when you have a mortgage, you have a debt, you have a dependent spouse or children, or like a loan. So typically you won't see your life insurance term stay forever. So most clients take a look at having lifetime insurance. That's participating whole life and universal life. They offer lifetime protection, build up cash value, a tax advantage environment, and the death benefits actually paid out tax-free. So very important there is that the whole life, universal life can also be considered its own investment class. And the fact is it has an estate benefit right away attached to those. So if I'm paying $100 a month or $1,000 a month, whatever it's going to be, right away, I bought that benefit. That something happens to me or to anybody else, that benefit is going to come out tax-free to someone else. So in simplest terms, life insurance creates an instant tax-free benefit in exchange for a scheduled premium. So you can use your insurance to help pay tax and other estate costs. You say, well, John, I do have those properties, those 3 houses in a row. And I got my RRSP, which is the RRSP becomes. And we say, you'll have the tax to pay. Okay, well, how do we pay for it? Well, I don't want to sell my property because I got 3 kids. I want them each inherit my estate. And you know what? I want to make sure that if I pass away, that my the rest of my retirement plan could be going to my grandkids and so that. So okay, let's use life insurance to pay a benefit that when you do pass away, that the benefit will actually be used to pay all these taxes. You don't have to worry about selling anything. So you have it there. Let's say that you're someone who has a business, and the business has been done very well as a family business for many years. And one of your children actually is involved in the business. So you know what? Well, Susie's actually involved in the business. She's the key person. She went to plumbing school. She's grown the company. It makes sense that we leave the business to her because that's the case. But Mark, my son, for instance, will say he's not interested in the business. He lives in London. He's a lawyer there. I'd still want to make sure they're equal. Great. So we're going to give, in my estate plan, we're going to give the business to our daughter, but instead to our son, he doesn't want to be involved in the business. Let's have a life insurance benefit in place so that fact that he will get his equalized benefit there. You can use life insurance to fund a charitable donation. That offers a lot of tax benefits as well. So, I like to maybe offset my taxes as well. Let's leave a big donation to my favorite charity, and that will also help pay the taxes as well. And a lot of times we're using, just for clients who maxed out their tax-free savings and RRSPs or they have pensions, putting life insurance dollars into like a whole life or universal life contract, it's another way of having a tax shelter investment where I don't have to pay tax on the growth of these investments. In fact, the matter is it's for a lot of people can be the right tool. So let's take a look at some examples. So Ted and Suzanne, this fictitious people, they're both 65 years old, retired with no debts, and have adequate cash flow from pensions to ensure the retirement plan to age 90. So we said, okay, let's plan to age 90. In doing analysis, we said, there's about 20,000 a year of surplus funds that you're just paying tax on based on having other investments. They don't need it for their retirement. Maybe it's in a portfolio which is gathering tax because obviously their tax-free savings might be growth here. They're also, with the income they're making on their investments, it's also affecting their old age security, where the fact everyone says, you're making too much money. We're giving you, let's say, the $650 a month for the old age security. We're going to take it back from you because you're making too much money. So in speaking with our financial advisor, they decide to reallocate this $20,000 per year into participating in whole life insurance. So ultimately, the base of this case is they're living well, they're retired, they have no debts, they have more than they need, and they're paying tax on this excess funds that they have. So he said, let's put it to somewhere else where we don't pay tax on it. So with $20,000 a year of premium, if they both passed away right away, their estate or the family would receive about $530,000 tax-free. So with this example, we're basically transferring this $20,000 a year from their taxable investments into a tax-exempt insurance policy. If we plan again to age 90, like in the previous page, the cash value at year 25 is actually $723,000. So you don't pay tax on the growth of insurance while the cash value is growing there. If they passed away at age 90, the benefit's actually over $1 million of life insurance. So the fact is life insurance does grow. If they had just kept investing the money at $20,000 a year, putting into an investment, they only have about $610,000. So ultimately, whether they just save the money in an insurance policy and there's their cash value at 722, or they just passed away with $1 million, their estate's going to benefit at age 90 and about $417,000. Again, you're saving tax using insurance, and the fact also is you just increase your estate tax-free. So ultimately their grandchildren and great-grandchildren, they actually have a nice legacy attached to them as well. So it's not strange that we have a lot of our clients actually in this position. We've done very well. We don't want to pay tax anymore. We pay a lot of tax in lifetime. What can we do? Our tax-free savings accounts are full. I don't want to borrow to have some tax deductions. Life insurance still is a pretty good option there as an asset vehicle to actually just not pay tax on the growth and actually have a benefit there. So the next option is, what if Ted and Suzanne unable to qualify for life insurance? So you know what? We went through the questionnaire and the medical, and maybe they both had cancer or had health issues, unable to qualify. The good thing here is actually qualifying for life insurance is not very hard. Actually, it's pretty simple. And on a last die basis, which we use here, It's pretty much almost not guaranteed, but it's very easy to do though. But let's say that they're unable to qualify or they want to go through the process. They could consider a cascading life insurance policy on their adult son, Jeff. So Jeff's just a made up name. So this, they say, okay, well, let's do this instead. Let's buy the life insurance, but we'll own it. So Ted and Suzanne will own the policy, but they'll have it owned on their son, Jeff. So what that means is Ted and Suzanne retain control over the policy, including the cash value, and they receive the benefit if Jeff passes away, or they can make, Jeff's spouse or his children the beneficiary, wherever they want to go. When Ted and Suzanne pass away, though, they can automatically, and assuming Jeff's still living, obviously he's a bit younger, they can automatically have the policy roll over tax-free to Jeff. So ultimately, Ted and Suzanne are putting in so much money per year into their insurance policy on their son's life. If they had put money aside into another investment and they had to transfer it to Jeff in the future, they'd be paying capital gains tax on this. With life insurance, it's got preferred status where I can roll over the ownership to the insured in the future anytime I want to. So using the same $20,000 per year premium into participating life insurance, if Jeff passed away, obviously he's younger, so the insurance benefits a little bit higher. Almost $944,000 would go to Ted, Suzanne, or to Jeff's spouse, or to Jeff's kids, whatever you want to be. And again, all they're doing is transferring this money from their taxable investments into a tax-exempt life insurance policy. So let's look down the road, and you don't pay for this forever either. You can pay for 10 years or 20 years, or we design a policy. You don't have to. You're not stuck to paying forever. It's not like the brick where you gotta don't pay for till 10 years and you gotta pay all this interest after. With life insurance, we can customize that. I can pay for X amount of years, and these are a lot of guarantees attached to them. So when Jeff is going to be a bit older, there 55 years from now, his cash value is almost $800,000. His insurance benefits almost $2.9 million. If they had just invested the money at $20,000 a year over those lifetime, about $956,000 as an investment. So ultimately, I'm looking, actually, I think I might have made a little slight mistake on the cash and the investment though, but I'll double check them all before I give it to Anna to confirm though. But the death benefit amount is accurate for sure though. And lastly, charitable giving. So ultimately, you're looking at your asset transfer. Charitable giving is a wonderful program in Canada. You could choose between a regular donation each year that will attract income tax credits, reduce your tax today. So whether you're doing $100 a month into just a direct deposit into TB Vets and giving the money, or you're actually buying a life insurance where you'll pay the premium, you're the insured, but TB Vets will be the beneficiary. This will all give you tax treatments. If you wanted to say, I want to donate my shares or my mutual funds or my bond or segregated fund or property while I'm living, you actually have no capital gains when you do these things. So ultimately, you say, well, I want to benefit my family today. There'll be a tax, obviously, but if I'm benefiting a charity, there's a lot of tax advantages there. If you're doing it from your estate at the very end, you can use a donation from your estate using life insurance. So in this example, if Jeff and Suzanne said, well, we really want to benefit the charity, so they're putting in $20,000 a year, when they pass away, they're leaving a tax-free benefit to, say, TB Vets, for instance, or any other charity across Canada. And when they pass away, that actual life insurance benefit amount will actually they'll issue a tax donation receipt based on the amount is. So it's an interesting aspect, though. You can really benefit not just your family with a life insurance, but also the charity, and that'll help reduce your final taxes. I'll go 1 second here. Any questions before I will plug myself one last time, and we'll go back to the questions, then I'll stop sharing. Again, if you have any questions, you can definitely talk to Anna. I'm in Vancouver at Broadway and Granville, and that's my contact information there for sure. So what I'll do is I will now stop sharing, and then if there's any questions, we could definitely have a chance to share here.
Thank you very much, John. This was very interesting. Did you see the 2 questions in the chat box?
Yeah, let's look at Larry. So Larry had a question at 413. I have company shares in a tax-free savings account. Are the dividends that get deposited in the account tax-free? Yes, the growth of your tax-free savings account will be tax-free.
And then there was a question from Janice.
What are the tax implications of the segregated funds being left to children of the widower? Okay, let me just go back to there. So with segregated funds, it's a bit different than a mutual fund. And the reason going is, if let's say I'm by myself, my wife is no longer, or I just own a contract with myself. If I pass away and name my children as beneficiary, they will receive the benefit the way it is. So I'll have 100,000, they receive it. My estate, though, my estate is going to pay tax on the growth of the investments. So even though it's the segregated fund, they receive the full benefit. My estate will pay the tax on it, though. So simple that way. With segregated funds, I didn't mention, is also a death guarantee. Not many people know about segregated funds. What happens is, the markets are pretty high back then. And on March 15th, I passed away and my markets went down 3%. With segregated funds, if I passed away, the guarantees your principal at death or the market, whatever is higher. So this example, if I passed away last March 15th, even though my investments from 100,000 to 70,000, my beneficiary receives the full $100,000. The tax on the growth of the investments and so on, though, again, my state pays that, though. So I have access there as well. If the markets are worth higher, though, they get the higher amount, though. A lot of times is, you also might have a case with segregated funds where, you know what, well, John, I have, we're retired, we're enjoying our life, going fishing, we're doing all our fun things, retirement. We have our 3 kids, we want to leave their investments to. But one of our children has had issues. You know what? They've had, they're bad with money. Maybe they had issues with substances, or they're gonna blow it all the next day. With segregated funds and life insurance, I can say it's not a problem. There's a settlement option where I can say, okay, my first 2 kids, they'll receive the full benefit tax-free, but my 3rd child will get it over a 10-year period. So instead of having to go get a trust set up, you're actually using segregated fund settlement options to do many wonderful things, though. So you actually are controlling your benefit beyond the grave then. Let's see, Shannon. Let's take a look at it. Usually it's always time to break it down. The last person would have been the common law spouse. Again, I would leverage this to one of my state lawyers for sure, though. But again, did they have any other children? Did they have any cousins or nephews? Whenever that, someone's going to get it, though. If you die with a small balance in the bank account, the bank's going to give it up, right? So under $50,000 investments, the bank will be the next kin, though. But they want to release the money as well, though. But that question I don't have the answer to. I'm going to copy and paste it, though. Give me 1 second. I will email it to myself, and I'll try to get the answer to that.
Thank you, John. Are there any other questions? Because we still have some time, so please don't be shy.
I wanted to see my contact information again. I'll put that back up.
Thank you.
Give me a second. I was just going to copy that message, though, because that's a good question for sure, though. Again, it's always good to have, in this case, though, if you're leaving money behind, obviously, an RRSP or RIF, tax-free savings accounts, life insurance, all these things have beneficiary taxes to them, though. But if you have money in a bank account, if it's not a joint owned account, though, then it's going through your estate, though. So it depends what you have, though. You can also name with segregated funds or life insurance policies, mutual funds, like if they're in an RSP or a RIF, you can name a secondary beneficiary as well. That also does work sometimes. So it depends what everybody has, though. Our company does offer secondary beneficiaries, but a lot of times the banks, I've never seen them do it, though. I'll put the contact information back up.
Thank you. Any more questions, anybody? One moment. Oh, yes. There's a question for you, John, from Tonya.
Okay.
Can you see it?
So I have no spouse and 1 child, a will and some rentals. It seems to me a situation is quite simple. Yeah, for sure. It can be simple. The big thing I would suggest here is ultimately comes down to, let's look at, is tax today and tax later an issue for you? Ultimately, if you sold your properties today, you're going to pay tax on it. If you passed away and left it to your child, there's going to be tax payable in the future there. You know, is your child ready? Obviously, if we're talking about a child, is that child under 18? Are they over 18? Are they ready to inherit things? So this is having discussion. You know, a lot of times you might say, well, I want to name my child and put them on title. Well, adding this on the title, technically you're giving part of the units up and so on. It's not as quickly there as well. Your child's very savvy, it's awesome. So it comes down to, and also sometimes you say, well, I want to put my child on title for investments. What if that child has health, financial issues and they get sued? Well, guess what? They're entitled to all these properties, half is theirs, right? So we try to avoid, you know, ultimately that's a simple solution though, but there's also pitfalls with it though. Again, if you're considering selling now, markets are quite high in real estate right now. You may say, no, I want to cash in my chips. I want to pay tax. I want to have, after I pay my tax, now it's tax-free, my benefit, after I'm done with it. I want to set up my legacy and do things like that. That's definitely an option though. But we talk to some clients though who maybe say, you know what, I'm not insurable for estate planning. And you know what, I'd rather sell a piece off at a time. And it's basically, it's called a churn and burn method, where I'll sell off assets every year as I go. And that's the solution there. So it all depends what's important. That's why I said at the beginning, what's important to you. If you're having the maximum cash flow now, I mean, obviously just paying the tax, it is what it is, right? So that's an option for you though. But definitely you want to be, obviously be aware of taxes. Like, no one told me there's paying tax these things. Well, yeah, you have to pay tax these things. Also, if you're going to sell these properties while you're living, you know, if you're dealing with a realtor, then if those, there's always going to be a thing there. Carl, child's not a resident of Canada. What happens to tax on death? That's a question we get all the time. For sure. It all depends on what is the investments we're having, right? So ultimately, if the beneficiary is this person and you know what, they're going to inherit a sum of money, they're definitely going to fly from where they are, present their papers and say, I want to collect my money. We had one fellow a couple years ago at the office. The fellow, he passed away pretty young, like 40 years old. He had life insurance through work, which we had set up a plan for. We do health and dental plans as well. He had life insurance. We had sold him. He had segregated funds actually for his investments because he's a business owner. It made sense. His sister, he had no wife, no children. Sister came in from Albania. She flew in. So it's going to cost about $2,000. Stayed with family. She basically, you know, collected her money, showed all her papers. She takes $500,000 back to Albania, which close to Greece, and my parents from Greece. For $500,000 in a country like that, you're very well off though. So again, you definitely, when you're doing any sort, if you're going to have someone who's not living in Canada, definitely make sure though that in your will it mentions that my child lives in this part of the world, and to be notified, or with the investment company or the bank, my child lives here. Make sure that is the person. You know, if their name is John Smith, well, there's lots of those people. Make sure you have the full name and so on though. So the more information, the better, obviously. Ultimately, it's a life insurance. They want to pay out the benefit. They don't want to leave it on there, you know, but it's any other thing, they want to make sure pay it out though. So definitely the more you communicate with your provider, that's the case. We do estate planning records with our clients. It's an event of death, call this person. So if you're working with a financial advisor, they at some point, and with the Zoom and Teams, of course, I expect I have a meeting with your child if they don't live in here, because ultimately when the time does come and I'm calling them, because ultimately as an advisor, we get hear things a lot quicker. So sorry, you know what, so Charlie, your mom and dad have passed away. And of course, yeah, we met on this. Yes, perfect. Just so you know, this has happened. Yeah, my uncle called me as well. Great. I want to arrange that when you come back to town in a week or two, that we can have our meetings so we can start doing some of your assets. Again, if it's going to be segregated funds or life insurance or tax-free savings or an RRSP, it's a simple process beneficiary. If it's anything else like investment portfolios for a bank or brokerage, or real estate, or it's gonna be other things, or you know, the China collection I have in the house, that's gonna take longer for sure though. So ultimately, one of my clients, one of the beneficiaries, or two beneficiaries to the segregated fund policy, two lived here, one was in Europe. So she had to come for the funeral anyway. So when they came, we signed the papers, and within a couple of days later, she got her check though. So
there's two more
transfer
questions.
tax, yeah, transfer tax. So this example is a property transfer tax. So I use this example very clearly. When you sell your home or a property and you use a real estate agent, you're going to pay commission to the realtor. as well as any lawyer fees. When I'm buying property, I don't pay commission, but I pay a transfer tax to the federal to the government of British Columbia. This transfer tax came, I think, in the 80s with Van der Zalm. It's very, very lucrative for the government. That so if you bought a home, let's say for $1 million, because there's some exemptions, so on though, but you're going to pay tax on so much. I have a friend of mine just bought a condo pre-build for about $900 in Vancouver. I think you're looking at $50,000 or $40,000 transfer tax. So basically, when you're buying property, you're paying the people in Ottawa a transfer tax. So I call it the commission to the government, actually, because it's the reverse of when you sell a bill. Can you gift your money to your kids prior to death? Is there a limit as to much? Free. If I'm going to sell the shares or my funds or my portfolio, my bonds, whatever it's going to be, those when I sell them have a capital gain or a loss, for instance, and that point there you pay tax on them as well. Ultimately, if you have multiple family members or like children, and you say, well, I gave Mike, I gave him a whole chunk of money before I died, and what happens later on? Your family says, well, why do that for? Was it under duress? And you're up in can of worms though. So ultimately, make sure any gifts you give during a lifetime, they're very clearly marked. Let's say you're giving Mike their money to buy a home, maybe make it in part of the will that we've already given him X amount of dollars. It's from my GIC. I pay tax on interest, but I don't pay tax on my principal, tax-free. If I'm gonna surrender any other investment where I've made a gain, I'll pay tax on it for sure. If it comes from my tax-free savings account, that's tax-free. If I'm cashing out money from my RRSP, that's taxable to me, and I pay tax. They take tax off the top though. So again, very ultimately, if you're giving a gift while they're living, what's the gift you want to give to them? Phyllis, if a house is in joint tenancy and husband dies, do I pay any fees other notary, lawyer fees, transfer house to single tenancy? Yeah, there shouldn't be except for lawyer fee because it's joint tenancy. So different story. Again, when you're married, there's always that rollover. But always make sure there's a will. It's very important to have that though.